Investing in Index Fund for Beginners. Welcome to Be a Baby Billionaire. In the vast landscape of investment opportunities, index funds stand out as a beacon of simplicity, efficiency, and reliability. These investment vehicles, designed to mirror the performance of specific market indexes, offer investors a straightforward yet powerful way to participate in the financial markets. Unlike their actively managed counterparts, index funds operate on a passive investment strategy, aiming not to outperform the market, but to replicate its performance. This approach has gained widespread popularity among both novice and seasoned investors for its low costs, broad diversification, and potential for competitive long-term returns. Index funds are built upon the premise of tracking the performance of designated market indexes, such as the renowned S&P 500. 1. Introduction to index funds. Index funds are a type of investment fund that aims to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Unlike actively managed funds, which rely on professional portfolio managers to select individual stocks or other securities, index funds passively track the composition and performance of a designated index. This means that instead of trying to outperform the market, index funds seek to match the returns of the index they are designed to mirror. They achieve this by holding a diversified portfolio of securities that closely resemble the components of the target index. Index funds have gained popularity among investors for their simplicity, low costs, and potential for competitive long-term returns. 2. Advantages of index funds. Investing in index funds offers several advantages that make them an attractive option for both novice and seasoned investors. One of the primary benefits is diversification, as index funds typically hold a broad range of securities across various sectors and industries. This diversification helps spread risk and reduce the impact of volatility in any single stock or sector on the overall performance of the fund. Index funds are known for their low costs, as they require minimal management and research compared to actively managed funds. This cost efficiency translates into lower expense ratios and management fees, allowing investors to keep more of their investment returns. Index funds have historically demonstrated competitive long-term performance compared to actively managed funds, making them an appealing choice for investors seeking consistent returns over time. 3. Understanding market indexes. Market indexes play a crucial role in the financial markets by providing benchmarks to measure the performance of specific segments of the economy. Popular market indexes, such as the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite, represent different aspects of the stock market and track the performance of a basket of underlying securities. For example, the S&P 500 index includes 500 of the largest publicly traded companies in the United States, representing a diverse cross-section of industries. The Dow Jones Industrial Average comprises 30 large, publicly traded companies across various sectors. Stock market. The Nasdaq Composite Index focuses on technology and growth-oriented companies listed on the Nasdaq Stock Exchange. These indexes are used by investors, analysts, and policymakers to assess market trends, evaluate investment performance, and make informed decisions about asset allocation and portfolio management. 4. Risk considerations. While index funds offer many benefits, it's essential to understand and consider the associated risks before investing. One significant risk is market risk, which stems from fluctuations in the overall stock market. Since index funds passively track market indexes, they are inherently exposed to market volatility. During periods of economic downturns or market corrections, index fund values may decline, potentially resulting in losses for investors. While market risk affects all investments to some extent, it's particularly relevant for index funds due to their broad market exposure. Another risk to be aware of is tracking error risk. Despite their goal of closely mirroring the performance of a specific market index, index funds may not perfectly replicate the index's returns due to factors such as transaction costs and portfolio composition. 5. Cost efficiency. One of the key advantages of index funds is their cost efficiency compared to actively managed funds. Index funds typically have lower expense ratios and fees because they operate on a passive investment strategy. Since they aim to replicate the performance of a specific market index rather than actively selecting individual securities, they require less research, analysis, and management. This reduction in overhead costs allows index fund providers to pass on the savings to investors in the form of lower fees. As a result, investors can benefit from higher net returns as a smaller portion of their investment is eaten up by management expenses. Over time, even seemingly small differences in expense ratios can have a significant impact on investment returns, making index funds an attractive option for cost-conscious investors. 6. Diversification benefits. Index funds offer broad diversification across multiple stocks or bonds, which helps reduce individual stock risk. By holding a representative sample of the securities included in a market index funds spread their investments across various sectors, industries, and companies. This diversification helps mitigate the impact of poor performance from any single stock or sector on the overall portfolio. For example, if one company in the index experiences a decline in its stock price, the negative effect on the fund's performance may be offset by gains from other companies in the index. Investors in index funds are less exposed to the risks associated with individual stock selection, such as company-specific news, management changes, or industry downturns. Diversification is a cornerstone of modern portfolio theory and is widely recognized as an effective risk management strategy for long-term investors. 7. Passive investing strategy. Index funds employ a passive investment strategy where fund managers aim to replicate the performance of a specific market index rather than actively picking stocks. This approach contrasts with actively managed funds, where portfolio managers actively buy and sell securities in an attempt to outperform the market. Instead of trying to beat the market, index fund managers focus on tracking the performance of a designated index by holding a portfolio of securities that closely mirrors the index's composition. This passive approach requires minimal intervention and decision-making, reducing turnover and transaction costs. While passive investing does not promise to outperform the market, it offers several benefits, including lower costs and potential tax efficiency. Research has shown that over the long term, the majority of actively managed funds fail to outperform their respective benchmarks, making the passive approach an appealing option for many investors seeking consistent market-matching returns. 8. Tax efficiency. Index funds may offer several tax advantages compared to actively managed funds, making them an attractive option for tax-conscious investors. One key advantage is lower portfolio turnover, which reduces capital gains distributions and associated tax liabilities. Since index funds aim to replicate the composition of a specific market index, they typically have lower trading activity compared to actively managed funds, which frequently buy and sell securities in an attempt to outperform the market. Additionally, index funds may employ tax-efficient strategies, such as tax loss harvesting and selective dividend reinvestment, to minimize taxable income and maximize after-tax returns for investors. 9. Choosing the right index funds. Selecting the appropriate index funds involves careful consideration of various factors, including investment goals, risk tolerance, expense ratios, and tracking errors. Investors should first define their investment objectives, whether it's seeking capital appreciation, generating income, or preserving wealth. Based on these goals, they can determine the asset classes and market segments they want exposure to. For example, Investors seeking broad market exposure may opt for total market index funds, while those targeting specific sectors may choose sector-specific index funds. Risk tolerance plays a crucial role in fund selection, as investors should match the fund's risk profile with their own comfort level. Expense ratios are another essential consideration, as lower fees can significantly impact long-term returns. Additionally, tracking error, which measures how closely the fund tracks its benchmark index, should be assessed to ensure alignment with investment objectives. By evaluating these factors comprehensively, investors can choose index funds that align with their financial goals and risk preferences. 10. Understanding asset allocation. Asset allocation refers to the distribution of investments across various asset classes such as stocks, bonds, and cash equivalents within a portfolio. Index funds can play a crucial role in asset allocation strategies by providing exposure to different market segments or asset classes. Investors can use index funds to build a diversified portfolio that reflects their risk tolerance, investment horizon, and financial goals. For example, a conservative investor may allocate a higher percentage of their portfolio to bond index funds for income and capital preservation, while a more aggressive investor may allocate a larger portion to equity index funds for growth potential. By diversifying across asset classes, investors can reduce portfolio volatility and minimize the impact of market fluctuations on overall returns. Asset allocation should be periodically reviewed and adjusted based on changing market conditions, investment objectives, and risk preferences to ensure alignment with long-term financial goals. 11. Long-term investment approach. A long-term investment approach is essential when investing in index funds due to their passive management style and focus on tracking market indexes over extended periods. Index funds are designed to provide broad market exposure and capture the long-term growth potential of the underlying market segments they represent. Therefore, investors should adopt a patient and disciplined approach, focusing on the fundamentals of their investment strategy rather than short-term market fluctuations. Staying invested through market cycles allows investors to benefit from the power of compounding and dollar-cost averaging, where regular contributions are made regardless of market conditions. Additionally, maintaining a long-term perspective can help investors avoid making impulsive decisions based on emotion or market volatility, which may derail their investment plans. By staying committed to their long-term investment objectives and remaining invested through market ups and downs, investors can potentially achieve their financial goals and build wealth over time with index funds. 12. Summing up, investing in index funds provides a solid foundation for building wealth and achieving long-term financial goals. These investment vehicles offer simplicity, efficiency, and reliability, making them an attractive option for both beginners and seasoned investors alike. By tracking the performance of specific market indexes, index funds provide broad diversification, low costs, and the potential for competitive long-term returns. Throughout this guide, we've explored the fundamentals of index funds, including their structure, advantages, and practical considerations for investors. From understanding market indexes to assessing factors such as cost efficiency, diversification benefits, and passive investing strategies. Time for the soft question. What makes index funds stand out, and why would you consider adding them to your portfolio? Please share your thoughts in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.